our first guest on the show, Mr. Ashutosh Bishnoi, MD and CEO at Mahindra Manulife Investment, is with us. Sir, thank you so much for taking out time for us. Could you just tell us about your global partner, Manulife? What are they telling you about flows, outflows? What are they factoring in terms of taper or interest rates hikes, if any?
Yeah, thank you. Thank you for having me. So clearly, what we are seeing is that though there is a mountain of fiscal support and there is a lot of back to work, but there is clearly high liquidity here to stay. Elevated valuations are here to stay for a while. And therefore, investors, we are advising that you should look at asset allocation differently. People are getting spooked by high equity valuations and very low interest rates. So they're looking for places to go to, and asset allocation outside of these two assets is where our partner is also advising people to go to.
Right. Indian investors these days are wanting to invest in abroad. What are you getting the feedback over there? Are you planning any such offerings in the near term?
Oh, yes, absolutely. So we are actually targeting now. We think the Indian investors understand real estate very well. And in that space, REITs have come to play. In the Asia Pacific markets, REITs are a $300 billion business. And they've been there for more than 20 years. So we are actually looking at considering an Asia Pacific REITs play, a fund of funds that will invest in Asia Pacific REITs. In fact, this fund will invest in a Manulife Asia Pacific REITs Fund, which has been there, has good performance, cuts across all kinds of real estate plays, from hospitality to hospitals to commercial to residential, everything. And these are markets that have been around for a long time. Generally speaking, people invest in this market only for income, but this particular fund has also an opportunity to invest in for capital gains because it also invests in property equities. So very interesting play. And this is the one fund that we are lining up. It's got a 13.5% since inception return, which is very good compared to most REITs. That's because it offers capital gains. We also advise people to look at outside India because if you think about it, the Indian rupee deteriorates against the US dollar over the last 47 years data I have. It shows a 4% annual deterioration. That gets added back into your earnings or your return if you invest outside India. So clearly, we think the home buyers should go and people should look at start investing outside India. At this point in time, when equity and fixed income both look slightly worrisome for many investors, a real estate play via a REITs fund is a good way to look at the market.
Right. So why would you think that Asia Pacific REITs Fund is relevant in the current market scenario?
See, fundamentally, because if you look at the Asia Pacific real estate market, Asia Pacific countries are in the front of back to work, back to normal life syndrome. Offices are opening up, shopping is opening up, people are living normal lives. Yes, of course, they're not allowing visitors from other countries, but their domestic life is coming back to normal the fastest. As a result, real estate pickup is very, very fast. And we think that Indian investors, even though they themselves cannot travel there, but certainly can send their money there to make good returns out of.
Correct. Since REITs is a relatively new product for Indian investors, what would be your message to retail and HNI category of the investors?
See, my message is simple. Because this is a mutual fund, for as little as 5,000 rupees, you can participate in real estate related investment opportunities across Asia Pacific. That's never been possible before. I know that Indian investors love real estate and property investments, but within India, there's always a challenge of all kinds, particularly you have to buy physical property and liquidity is an issue, even timing, there are taxes issues. But here, all those issues get resolved because your money, as little as 5,000 rupees, can go and buy you a real estate opportunity to participate in. That's the simple message I have.
Your thoughts on Indian valuation, especially after the rally? Q1 numbers are probably what is expected in this current financial year.
So we believe that, like everywhere else in the world, Indian equities are some parts of it is stretching the valuations a little bit. As fund managers, we believe this is the time to be a little more defensive, and you can see that happening already in many parts. We certainly are. And by that, I mean that you have to start reallocating assets between different market caps, probably away from small and mid, a little more in towards a large. But clearly, there is no sectoral play yet emerging. Sector rotation has been very fast in India over the last 1.5 years, and it's impossible to say whether you should put your bet for the longer term on one sector or the other. So we have to be a little more nimble footed. So that's how I think most institutional investors are approaching the market.
Right. In terms of, how would you look at sectors? Do you think stock specific, sector specific things would still do well, or with such valuations when the correction happens, that will also be swift, leading to companies that have good fundamentals also falling due to the sort of outflow that one can expect?
So I would say valuations are likely to remain stretched not because of any other reason than the global liquidity that is refusing to go away. So to say that the markets will correct tremendously, I would not go that far. But yes, you may see stock specific corrections also. I think this is a stock specific market. It's not yet a sector specific market. Yes, you can say for some time, materials did well. For some time, some part of the banking and financial services did well. But it moves so fast that you really have to catch the trend and stay with it for a 1 quarter, maybe 2 quarters max. So it's clearly a job which has not been done before. We are living in different times. Elevated valuations over long periods of time has never been there in our markets. Typically, markets correct very fast. But this time, we believe we have to be nimble footed to be on the right side and catch the right trend. Stock specific, even in small and mid cap, which I keep saying has got a little bit overvalued, even there are stock specific opportunities even today. So this is a time your research is stretched the most. They work the hardest to come up with ideas that are likely to make good money for investors.
Right. Also, I just wanted to understand about the fact that, say if there is any tantrum, or the point that you made that liquidity is just available in such a big way. But don't you think growth rates are high? A lot of these metal companies have come down and reduced their debt quite significantly. Nobody is taking heavy debt, whether it's global or local. Do you think that, even if it was to happen, it may not be the event like 2013 where everything just came down because of debt, deleveraging, currency movements here and there?
No, you're absolutely spot on. I don't think we are going to see a massive come down of any sort. It will be sporadic and it will come in parts, unless, of course, any geopolitical issues happen. But I think that's a little bit behind us for the moment. But quite clearly, these are times we'll have to learn to manage monies in in elevated valuations, and therefore, I put a case across saying that this is time to look at different assets right now, and therefore we are veering towards real estate, which I think is of very high priority for Indian investors. I mean, in fact, as if you look at Indian households and their balance sheets, the highest exposure is to real estate. People like it. They've never been able to participate it from a financial security perspective, and I think that opportunity is right here and now.
Right, sir. Thank you so much, sir, for taking out time for us. All the best with the REITs launch that you've planned for various investors. Thank you so much.